Trading Live. You are now part of a growing group of do-it-yourself traders who are trying to change the way investors think about building wealth. But because we don't believe in using financial advisors, stock tips, or traditional financial media, we have to do things different. We have to do things smarter. We do that through an art and a science we call trade hacking. At Navigation Trading, our methodology is based on statistics and probabilities, not hype or emotion. Our core strategies have been used by market makers, hedge funds, and floor traders for many years. Now, we share these secrets with you. Whether your goal is to make an extra $1,000 per month or replace your current income, with our guidance, you can achieve financial success beyond your wildest dreams. So, let's get started.
Good morning, Navigation Traders. It is 8:25 a.m. Central Time, Monday, November 27th. Welcome to Navigation Trading Live. So glad to be back after an extended Thanksgiving weekend. Hope everybody had a great time spending time with your family, enjoying some time off, hopefully. And can't wait to get back to trading. I don't know if you guys are at all like me, but after a long weekend like this, I'm basically itching to just make a trade. So glad to be back. Can't wait to get this week started. Hopefully we get some implied volatility spikes to give us some more opportunity. But if not, we'll continue to manage as needed. So quick note, like I mentioned every time, this broadcast is all about you. So if you have any suggestions on topics, questions, post your comments here on Facebook or YouTube, or shoot us an email at info@navigationtrading.com. And as always, if you can't be here live, as I know a lot of you have real jobs, so you can't just trade all day, this broadcast will be posted to Facebook, YouTube, and Twitter immediately following the event, so you can always watch it, watch the replay. So what I want to do here before the markets open and before we jump over to the platform, I want to talk about a topic. And this is, and I put it at the bottom here, thanks to Bill M., one of our members, who wrote in with a question about calendar spreads. And the question was, you know, in our calendar course, we mentioned we always start by putting on a put calendar. We prefer to use put calendars over call calendars. And he's trying to figure out why that is. And the reality is the difference between put and call calendars is pretty small. And I'm going to go over an example here. But the bottom line is, with our backtesting and research and just trading over the last 16 years, what we've realized that our edge, our profitability is just a little bit better in puts. And it has to do with the put skew of the options and the way they're priced based on the risk of the move with put options versus calls. So let's go to the platform and take a look at an example. And this will be the trade that we put on today for our trade of the week. But let's go ahead and get this set up even before the markets open and take a look at an example. So if we take a look at the option chains, we've got 18 and 53 days. Now, we talk about putting the front month on kind of in that 30 to 60 days in the course, but some of the research that we're starting to do is telling us that putting on the front month with the shorter dated options, so kind of having the long dated options being that 30 to 60 range, but the short dated options being that kind of 14 to 21 day range to expiration, and they're actually performing better. Now, before we change our whole methodology and strategy, and I changed the whole structure of putting on the trade in the course, we're still continuing to do more back testing because we always want to optimize and maximize our trades for the optimal amount of profit. But for now, I'm going to go ahead and look at this using the front month of 18 days because we have found that they are performing better. Now, what we want to make sure of is we don't want to just take a small sample size of a couple years of data and say, oh, you know, this is a better way to do it. Because it may have performed during that couple of years, but over the long term, that may not be the case. So that's part of what we're still testing. But for now, let's go ahead and take a look. And there's the bell. So before we jump into that, let's go ahead and do this. So with 18 days to expiration, so I'm going to open that up, and we're in SPY, the S&P 500 ETF. Price is trading at about 260. So we'll look at the 260 put calendar. So we'll just buy calendar. And we want to go to the next monthly for the long dated option. So that'd be the January 19. That's the one we're buying. Remember the calendar spread, we're always selling the near term or the front month, and we're buying the longer term, which in this case is the January 19th. Okay, so let's go ahead and right click and analyze that. And we'll leave that there, and we'll go back, and I want to do the same thing on the call side just to give you an idea of the comparison. So if we go down to the same strike, the 260 strike, on the call side we right click, buy calendar. Use the same expiration cycles. So we're selling the December 15th and we're buying the January 19th. And we're going to go ahead and right click and analyze that. Okay, so now we've got both. So let's start out by taking a look at the put calendar. So we only have the put calendar clicked on. Let's set our slices to break even like we like to do to get an idea of our probabilities. And something didn't happen there. Set to break even, 12.16. And for some reason this one's not moving, so let's just manually move it over to our break even point. Make sure this one's on the break even. There we go. And we've got this to our expiration date. So about 47% probability of success between now and expiration. Now if we take a look at the, and let's add one more slice here. And we'll put this one on price, exactly where it is. So that's on 260.37. That's where price is trading. So a couple things to look at here. I already mentioned the probability is about 47%. The reason I wanted to put a slice on where price is because I want to see where the theta is. So it's about $2.65. So if price stayed right where it was and volatility stayed right where it is, we're collecting about $2.60 a day per contract. Now let's go over to the call calendar and see what that looks like. So let's go ahead and delete this slice first. And you can tell right off the bat, look how much more narrow of the probabilities are. So we've got to move these in on the call to the break even on the call calendar and move this one in to get an idea. Now we're at 36%. So we went from 47% probability to 36%. Okay, so that's the main key reason why we prefer puts over calls. Now, if we also just move this over to price to check out what the theta is, you can see we've got much lower theta. So we're collecting less daily theta on a call calendar. We have a lower probability of success. Now, keep in mind, this only cost $1.22 and this cost $1.37. So that has to be factored in as well. It's not exactly apples for apples, but that hopefully gives you an idea, excuse me, of why we prefer the put calendar over the call calendar. Now when we adjust, if price comes to the upside and breaks through our break even, just to keep things simple and straight in our platform, when we adjust, our first adjustment to the upside would be adding a call calendar. And by doing that, it's helping you keep the trade straight. So you know which one was in the adjustment, which one is the original. It just helps things keep straight. But that's why we prefer put calendars over calls. So I hope that was helpful. Let's before we actually, so we'll just go ahead and delete the call. So the put calendar, this is our trade of the week. We'll look at putting this on. Remember, we like to do calendars in periods of low implied volatility. Now we are getting a spike up today, so I'm gonna look at this order and make sure the risk reward is completely fine before I shoot it out. Depends on where I get filled. I like to do calendars when it's really under 20, so we may or may not end up shooting this out to our alert subscribers. But I really wanted to put on that example to show you the difference between puts and calls anyway. So let's go through the different symbols on our watch list and check out what's going on. Stocks relatively flat. You've got the NASDAQ down a tiny bit. The ES, the S&P, the Dow, and the Russell are up a little bit. We've got bonds pretty flat to up. Oil's down about 1.5%. Gold is up almost 1%. You can see nat gas is a big mover today. He had a huge move down on Friday and over about 4.5%. Now it's a rebound up about 3.5%, so it's rebounded nicely. We've got a position on there in our alerts portfolio, so that'll help us out on that move. You can see all the grains are down a little bit. Some of the emerging market ETFs, Mexico up a little bit, the Euro up a little bit, the EEM and EFA down, EWZ down, and XRT is up a little bit, the retail ETF. Some of these oil-related ETFs are down, along with the price of crude oil. So nothing too big as far as movers. Let's take a look at some of the main stocks. We look, Amazon up big, almost 2.5% on the open. That's a big move on top of what's already been a big move in Amazon, so it continues its rally to the upside. BBY, which is Best Buy, up over 1%. Baidu down 1%. See if there's any other big movers here that we need to be aware of. Momo down 1%. Tesla down about 1.5%. So, and that's it as far as really big movers. So that is what's going on in the market. So I'm going to take another look. I'm going to go ahead and stop the recording here, but I'm going to take another look at the SPY calendar with the pop-up and implied volatility. I most likely won't put this on, but depending on where the options shake out as far as pricing, we will take a look. If we do shoot it out, Navigation Alert subscribers, you will get the alerts via text and email. If you're interested in checking out Navigation Alerts, we still have a 2-week trial for just $7. So if you're interested, go ahead and check that out. Everybody have a great week of trading, and we'll talk to you next week.